Meet Karan and Arjun. Both of these ambitious friends have recently launched their own independent wedding photography businesses. First-year numbers are in. Karan generated 3 lakh in profit, while Arjun generated 4 lakh. Who is the better owner? Intuition points to Arjun. He made 33% more, and a bigger bottom line is typically seen as the ultimate marker of success. However, taking these absolute numbers at face value is a classic trap that routinely misleads amateur investors. Judging a company strictly by the size of its profit obscures the foundational half of the story. We are missing the variable that provides the necessary context: invested capital, or equity. In this case, equity represents the upfront cash required to purchase the cameras, lenses, and hardware needed to start the business. This diagram reveals their starting capital. Karan launched with 10 lakh rupees in equity, whereas Arjun poured 15 lakh into his setup. By pairing initial inputs with final profit, we finally measure the true efficiency of each business. Analysts evaluate this relationship through a metric called return on equity, or ROE. ROE ignores the volume of money made to focus on how hard every invested dollar worked to generate that profit. The calculation is simple. Take the profit, divided by the equity, and multiply by 100. Using Karan's data, 3 lakh in profit divided by 10 lakh in equity, we get an ROE of 30%. For Arjun, that 4 lakh profit required a heavier 15 lakh equity base, resulting in an ROE of 26.6%. The math reveals Karan operates a business machine with significantly higher raw efficiency. A smaller absolute profit generated from a lean capital structure is superior to a larger profit that relies on massive, inefficient spending. This exact efficiency math scales to the global stock market, where Wall Street uses it to evaluate multi-billion-dollar corporations. However, expectations for a good ROE are dependent on the specific sector a business operates in. Software companies require very little physical equity, mostly servers and laptops, to generate massive returns, which leads to a naturally high ROE. In contrast, heavy manufacturing plants or airlines require billions in upfront machinery and planes, inflating the equity base and lowering the baseline ROE. Because these business models are mechanically different, comparing a software company's ROE directly to an airline's creates a false equivalency. Meaningful benchmarking requires that investors only compare companies operating within the same industry. A smart investor looks at a specific sector, like aviation or tech, to find the Karan of that group, the single company with the highest relative ROE among its direct peers. Corporate headlines often tout record-breaking profits to distract from the massive amount of capital wasted to achieve them. Ultimately, the true strength of a business is measured by how little capital it consumes to produce its results.